Good morning, everybody. Welcome to 2026. Happy New Year. All right, I'm going to give it a few more minutes to let anybody that is coming a little bit late to join our discussion. I will get started in just a few minutes. Hopefully, you can see the screen for January 2026 monthly market update. So give me just a minute, and then we will get started shortly. Okay, hopefully everybody can hear me. I'm still trying to get a little bit. Um, there we go. I think I can spotlight myself so everybody can see me. So welcome to the January 2026 monthly market update. This is a continuation of the webinars that I do on a monthly basis to provide an opportunity to update you on what's happening in the economy, the global and the U.S. domestic markets and the economy, and to provide you an opportunity to ask questions and to discuss what you are hearing and seeing out there, and as well as what I'm hearing and seeing. So, in the email invitation, you should have received a quick hits summary. It's a quick PDF review of some of the things happening in the markets and the overall economy. That's published by Commonwealth Financial Network, our broker-dealer. And there's as well a video blog post by Chris Fasciano, who is Commonwealth's chief market strategist. So provide those as an opportunity to read and review that information ahead of this webinar, and then I go through some of that detail additionally, just to kind of focus on it and make sure that you have answers to all of their questions. So with that, let's just kind of get into it, and we can talk about how things have been going. If there is a question that comes up during the session, feel free to unmute yourself and to ask the question, or if you need some clarification or need me to slow down, happy to do so. Also, I do request that any questions be generic or roughly, anonymous in nature, rather than specific to your personal financial situation. If you do have a personal question based upon something that we discuss, let's take that offline and talk about that personally. So this is for broad general information for everybody. All right. So with that, let's get going. All right. Let's look at the quick hits. So the summary is, so it was a holiday shortened week, trading week at the end of the year last week. It kind of was a little bit of a dud going into the end of the year. All the major indices declined, with the Nasdaq down 1.5%, being the worst performing. So, not surprising given how much the Nasdaq has run up as well. So growth-oriented stocks came under pressure last week, as investors rotated into more economically sensitive stocks like energy. Treasuries declined as well, as yields on the 10-year bond rose 5 basis points to just under 4.2%. So then the questions were, what could 2026 bring? We'll discuss some of that. There was a report on the GDP that showed continued strong momentum in the U.S. economy, led by consumer spending, as well as the December Open Market Committee minutes. That's the Fed, showing that the Fed is somewhat divided on cutting interest rates going forward. So again, the Nasdaq led the decline with equity markets down across the board. Energy stocks were the best performing, and we're going to talk about energy as we go forward, particularly in light of the recent news about the taking of the Maduro regime, Nicolas Maduro from Venezuela. So we're going to look to see for some December employment reports coming in this Friday and readings on manufacturing and service. So that'll give us some indications of how the economy is going moving forward. All right, so that's kind of the quick hits. It's published. There's some additional information in that PDF, but I want to just do a quick review of how the markets have performed over the last month and year to date. So this slide just kind of shows how the various markets performed over the last month. So the Dow Industrial Average was up slightly to 1.64%. The S&P 500, that's kind of the broader indication of the overall stock market, was up just slightly, just under 0.5%. And the Nasdaq, which is very tech heavy, a lot of tech stocks in that index, was down slightly. Now, continuing on its strong performance, the MSCI index, that is the index for international developed growth companies, that was up 3.18% for the month. So continuing that strong international performance and slightly, excuse me, slightly related to the continued sliding of the US dollar. And then the Bloomberg US aggregate level, that is an index of the bond market. And so as you can see, the bond market was relatively flat, just slightly up. So that's how things performed in December. If we step back out and look at how the year went, things look a little bit more positive. And by all measures, 2025 was a spectacular year in the markets. So as you can see, the Dow Jones was up 12.97%, so almost 13% for the year through December 31st. The S&P was up even more at 16.39%. So a 17% return on the S&P 500 is pretty phenomenal performance. The Nasdaq, again, being tech heavy, and a lot of the tech companies that have been in the news have been leading the charge on the stock market. So that's not surprising that the Nasdaq is up 20.36%. And now you can see the darling of the year was international, up over a third, or almost a third, by 33.11%. So international stocks were definitely the winner for 2025. And that is a good reason to step back and think that having a diversified portfolio that includes international, emerging markets, other things outside the U.S. Is a good thing for both additional returns at times as well as diversification. Okay. All right. Lastly, on this chart is the Bloomberg U.S. Aggregate Bond Index. So bonds were up 7.3% for the year. So by all measures, a very good year in the markets across both fixed income bonds as well as equities, being the other indexes. And this is a point to contrast because 2022, just a few years ago, we saw the exact opposite, where equity markets and fixed income markets were both down at the same time. Okay, so that is some a quick snapshot of the markets. We're not quite to Q&A yet, but let me continue on with a few other points of my commentary. So I mentioned that December was a mixed market, but we ended positively for the year. A lot of that is being driven by strong performance in the economy, particularly the U.S. economy. Now, once the government got reopened after the shutdown. They finally were able to get the GDP reports out, and the third quarter GDP report came in well above expectations at 4.3%. I think that the expected rate was somewhere around 3.3 to 3.4%, and this came in almost a full percentage point above the expectations. Um, so that means that Americans are still they're still working, they're still spending money and driving the overall economy. And so, that growth, it continues to drive the economy, company profits, and it's company profits and earnings that ultimately drive the market. Okay. Um, Now, if we shift a little bit to the bond market, obviously, like I said, the bond market continued to grow. The Federal Reserve cut rates 3 times last year. The last one being in December, to bringing the Federal Reserve rate between 3.5 and 3.75%. Okay, there is a ongoing expectation that the Fed is going to continue cutting rates by 1 to 2 cuts throughout the course of 2026. That is going to largely be dependent upon how the jobs reports and the overall economic reports come in. I think it's a little bit hard for them to argue for cutting rates if the economy it seems to be accelerating. But the flip side is that we've been having softening jobs reports. So generally speaking, when the economy heats up, the Federal Reserve will raise rates. Conversely, when you have a softening economy and rising job losses or rising unemployment, that's when the Federal Reserve cuts rates. Well, we're in this situation. So we were not in a job loss environment yet, but the last jobs report came out indicating that only 64,000 jobs were created in the month of November, which is down fairly substantially from where it had been earlier in the year, where we were producing somewhere between 150 and 200,000 jobs each month. So the last jobs report was not great, but it wasn't terrible. And there's probably a couple of factors that added to that. Obviously, the government sector has been shrinking, so some of those jobs have been taken off the board. The unemployment rate ticked up to 4.6%, which is, it's up a little bit, but it's not up significantly. So the Fed's going to be in this quandary where if it does look like the economy is starting to accelerate again, that leads to additional inflation pressure. When we might be in this situation where we've got economic growth, but also job losses at the same time. And so how they're going to thread that needle is going to be interesting. Okay, one interesting caveat regarding the bond market and overall fixed income prices is that um, the I don't expect that mortgage rates are going to come down that significantly. Right now, mortgage rates are sitting around 6 to 6.5%. If we have another 1 or 2% Federal Reserve rate cut, again, those are short-term rates, and generally speaking, when we're talking about mortgages, those are longer-term rates, at 15 or 30 years. So there's quite a difference between the movement of the short-term rates and how long-term rates, such as mortgages, move. But they do tend to come down in some degree of tandem. So I could see mortgage rates coming down between maybe 5.5%, somewhere between 5 and 6% over the next 1 to 2 years, as if we continue to shorten short-term interest rates, if we continue to lessen short-term interest rates. The biggest watch out right now for the markets and the overall economy, again, still continues to be that unemployment or that overall employment picture. Besides what I mentioned about the government trimming jobs, we also could be starting to see the effects of some of the technology changes, particularly around AI starting to take hold, where companies are able to replace human workers, with um, AI agents. So that's going to continue to be a theme, for probably the next couple of years. And we have yet to see how that's going to affect the overall economy. But generally speaking, that would tend to be positive if you need less workers, or at least the same number of workers to do more work. That would be positive. That'd be a contributing factor to the overall economy. Lastly, the big news, big item in the news right now, which is all around the discussion, is the capture of Venezuelan President Nicolas Maduro and his wife, and what happened in Venezuela over the last few days. So obviously that's going to be something to watch, um, and how involved the U.S. ends up becoming in Venezuela and South America is going to have an impact on the overall economy, particularly, very, importantly, the oil market. Um, but I don't at this point see it being a huge effect on the overall U.S. economy if we don't end up getting ourselves, really mired and involved in trying to run the country like we did with Iraq and Afghanistan. Venezuela has a long way to go to become a major oil producer again. Their oil infrastructure has been in significant decline for a couple of decades now. So it's not like this is going to be able to be changed overnight. We're talking about probably a number of years to get the Venezuelan oil production back to where it was just 2 decades ago. So I think from an investment standpoint, the jury's still out. I know there's a lot of political talk on this, so we'll see where it goes. I will say that the markets did seem to like the change, because there was a pretty significant spike in the markets right after the announcement was came out. So on Friday and then this last Monday, which that's softened a little bit since now. But I mean, overall, since the announcement, the markets are up 2%, over 2%, which is a pretty significant change for just a couple of days. So this is a wait and see for me. It has some potential ramifications, sizable ones, but it's going to take some time for those to play out. Okay, so I've been talking enough. Let me open it up for any questions that anybody might have regarding the markets, what's happening in the news, or otherwise. So, all right. If there are no questions, hopefully, let me go ahead and stop sharing. Or actually, I'm going to move on so that's for our questions and discussion. Let me just summarize what's coming up next. Uh, as I mentioned in the last couple of sessions that I've done, I do this monthly market update typically at the beginning of the month, generally the first or second Wednesday of the month, depending upon when the information comes out. So the next one that I'm going to do will be Wednesday, February 4th, basically a month from now, at 11 a.m., same time, same bat time, same bat channel. Also, I alternate doing a education session on various topics that relate to your investments and financial planning and those types of things. So the next session that I'm doing is going to be on investor psychology, talking about how our brains impact our investing decisions. And so that is coming up in a couple weeks on Wednesday, January 21st at 12 p.m. So brown bag lunch. Feel free to join me and we'll talk about psychology. Okay, if there's any topics that you have of interest in or would like me to speak on, or I have lots of potential guest speakers to bring on board on various topics, let me know and I'll see if I can get those into the queue. Okay. So with that, Oh, some of the upcoming topics in the next coming months. I think we're going to be doing some on evaluating and using data to evaluate investments, some more of the quantitative aspect. We'll be talking about Roth conversion strategies, and so those are a couple of ideas, a couple of topics that will be coming forthcoming in the next couple of months. So just keep your eyes posted for that, for the invitations coming out. So, all righty. That is it for today. Thank you for joining me. As always, if there's somebody that you think might enjoy this, they're posted to the website. You feel free to forward the invitation to them, have them join us, and happy to have additional discussions with anybody on any of these topics. So, all right, go enjoy the start of the new year. Enjoy your January. And with that, I will call it a wrap on this. All right, thanks a lot, everybody. Take care.